Yes. So we should know that how we can transfer the expenses into the income statement. We know that expenses have the debit nature. It means that whenever we incur the expense, so it will debit, and uh, whenever we need to incur, like we need to write or record the expenses, so it will be debited. Okay, so when we need to credit the expense, now this is the question. When we need to credit the expense, we need to credit the expense when we are going to transfer all of the expenses, like the whole year's expense, into the income statement. It means that whatever the balance you have in your expense account in whole year, in complete 1 year, in complete one financial year, you need to transfer the balance of the expense account into the income statement, because we know that in the income statement we record revenues and purchases, opening, closing inventory, and return inwards, return outwards, and carriage inwards, carriage outwards, and then expenses, other incomes, these kind of things. So when we need to transfer the balance from the expense account to the income statement, so we will credit the expense account. It means that we are crediting it. Why? Because we are reducing it. We are reducing it. Why? Because we are transferring its balance into the income statement. That is why the expenses will reduce by crediting it, meaning that we are transferring this into the income statement. So how do we record the expenses in the income statement? So there is an accounting concept. Now, what does it mean, matching concept? So let me let's make a format of the income statement. First of all, we know that we write the revenue, and then we need to deduct the cost of sales. And the cost of sales, we have opening inventory, closing inventory, purchases, etc. I'm just going to skip that part.
Okay.
And when we deduct the cost of sales from the revenue, so we know that we'll get the GP. And from the GP, we need to add the other income. Other income, we have the discount received, commission received, gain on disposal, and decrease in provision for doubtful debts. So there are a lot of other incomes, and we need to deduct the expenses from here. Okay, so let's take one example of expenses. For example, let's talk about the wages. Why we are writing the wages of this company here? Because we are okay. So remember one thing: whether you have paid the wages to your workers or not, you need to find out that what is the annual wages. Let's say my annual wages are $12,000. Let's say it means that $12,000. Okay, so $1,000 for the 1 month. That is why annual wages will be $12,000. So even if you paid these $12,000 or not, you need to write a $12,000 here. Why? We need to write the annual expenses. We need to write the annual income. We need to write the annual sales. Even if you haven't received that income or expenses, even if you haven't given that expenses or not, but whatever the annual wages are, you need to write it, because we are following the I provided, which is $12,000. The wages I provided to my workers, it helped me to earn this revenue. I can say this, yes, because if the wages let's say if I wouldn't have given any wages to my workers, so how they will be working for me? Okay, so of course they will not work for me. So if they will not work for me, so how I'll be able to produce the product, and then how I'll be able to sell it, and how I'll be able to earn this revenue. So it means whatever the expenses we incur, This is just because we want to earn this revenue. And whatever the revenue we have earned, all of the cost and expenses which we are writing, we incurred all those cost of sales and we incurred all those expenses just to earn this revenue. It means that my expenses are matching with this current year's revenue. It means that whatever the units I have sold during the year, so wages basically contributed towards that revenue. This is called matching. Understood?
Yes.
And same thing, you can maybe take the other types of expenses as well. For example, if you say okay, depreciation. Okay. So how the depreciation is also following the matching of that? Yes, it is also following. Why? Because depreciation means that we have used the machinery. For example, if I purchase a machinery, let's say in 2015, and now this is 2016, and I am going to make my final accounts. So in this whole year, of course, I have used this machinery, and we know that with the passage of time, when you overuse your machinery, or maybe even after a year, your machinery will be losing its efficiency. Why? Because you have used it for the 1 year. That is why it will be losing its efficiency. So basically, the depreciation which I am charging here, it is showing us the expense that since I why it loses value and its efficiency just to earn this revenue. Because of its efficiency, I was able to increase the output, and I also was able to increase the revenue. And whatever the depreciation I am charging here, this is totally I have, you can say that this is incurred because of this revenue. So it means that every cost and every expense is matching with the revenue, and it should be. Understood?
Yes.
Okay. So, okay. So that is a matching concept, and that is why we are recording the expenses, because we have to match this with the incomes. Okay. So expenses should be recorded for the financial period in which they incurred. Now, if you have paid it or not, there is no debate about it. You need to write the annual expense under the expense section. So value posted to the income statement for an expense should be the actual amount invoice for that period. Invoice. It doesn't mean that we have paid. Let's say if $12,000 is the annual wages, and I have paid, let's say, my workers only 11,000. Only 11,000 paid. Only 11,000. But I will write $12,000 in the income statement, because income statement says, the IES says, the matching concept says that you should record the annual rent, annual expenses, annual income. It doesn't mean that whether you have paid it or received it or not. No. So there is nothing, like there's no connection between the payment with the incurred expenses. You need to charge the annual and income, annual revenue, annual cost of sale, and annual expenses. So entries are made in the expense account during the financial period when payments are made at the end of the year, so that it will be more easy for you. But if you want to read this document, so you can read it as well. But let me, oh, this is for, I think that was, 1 second.
I have a question.
Yes, yes.
I didn't understand why you took 12,000 to the income statement, but you already paid 1,000.
No, actually, I paid
In some.
$11,000, but
Yeah.
my annual rent is 12,000. Sorry, annual wages. There is a basically a kind of I already discussed the matching concept. So there is a rule. It says that whether you have paid or not, you need to write a $12,000 in the expense, because you get the service. Let me tell you, I'm just going to explain this thing.
Okay.
Okay, so let's say this is my expense. Now, first of all, just go through some, there are some definitions. Okay, for example, uh, there's a term and the term is prepaid expense. And there's a term prepaid expense, and you can also say advance expense, but this the Cambridge, they use prepaid. They use this terminology. Approved, sorry, advance expense. Now, what does it mean? For example, let's take the example of advertisement expense. Advertisement expense. Okay. For example, your advertisement expense, annual advertisement expense is means yearly. Annual advertisement expense is equal to, let's say, $12,000. It means that per month, 1,000. Per month, 1,000. Okay. But now this is the expense. This is we need to pay. We need to pay $12,000 in whole year. This is the total expense. But the payment and the expense is a different thing. For example, if the company paid $15 on, let's say that 31st December 2025. Let's say this is my year end, and it means that my year start is 1st January 2025, and my year end is 31st December 2025. But I have paid $15,000. But my annual rent is only, sorry, my annual advertisement expense is only 12,000. But I have paid 15,000. Okay. So if we just deduct this 15,000 minus 12,000, it means that I have paid $3,000 extra. So whenever you, this is my advance expense, meaning that this is my accrued expense. Sorry, prepaid expense. Prepaid expense. Meaning that I have paid some advance expense. I haven't received the service yet because I'm standing on 31st December 2025. Here, I haven't received any service for the next years, next months. I've just completed the 1 year. I haven't received any service, the advertisement service from the advertisement company. So this $3,000 is basically your prepaid expense. So prepaid expense didn't incurred expense but paid in advance. Okay. This is called prepaid expense. Okay. Now we are going to discuss another expense, and that is accrued expense. Okay. So now, first of all, remember one thing, that is $3,000, which we have paid extra, which is prepaid expense. This is the asset for the company. Why? Because we can show the ownership on this $3,000. We can show the ownership on this $3,000. Why? Because, for example, if I don't want to continue, let's say, like the, you know, if I don't want to continue with the same advertisement company, so I can say to that advertisement company that, okay, I don't want to continue. So since I have paid you extra, which is $3,000, so you need to pay me back this $3,000. Okay. So that is why we can show the ownership on this $3,000. That's why the prepaid expense is the asset for the company. Okay. Now, what is accrued expense? So, accrued expense, for example, that let's take another example, um, rent payable. Rent payable is the expense for the company. Let's say your annual rent payable 24,000. This is your annual rent. But company paid $18,000 on 31st December 2025. This is my year. So from 1st January to 31st December 2025, the total expense is the annual expense is 24,000. But you have paid only $18,000. Okay. So $24,000 is the annual expense. So it means that for 1 month this is equal to 2,000. So when you will divide this 18,000, okay, so see that 18,000 will be, I guess, this is for only 9 months. This is for 9 months, I guess. Yes. You have paid this $18,000 for 9 months only. But you use the service. You use the house or the rent, sorry, the factory. You have used the factory for the whole 1 year, but you haven't paid the amount for 3 months. You paid only for 9 months. You didn't pay for the rest of the 3 months. So rent payable of remaining 3 months meaning that you have received the service because you have used the factory, but you haven't paid yet. So means that accrued expense you have used the service but haven't paid yet. But in the income statement, you need to record a $24,000. You will not record it in because income
Okay.
statement says, matching concept says that you need to write the annual, whether you have paid it or not. There is no connection. So this is the road expense. Now the remaining 3 months payment, this is liability for the company. This is a liability for the company. Understood this concept?
Yes.
Accrued expense and prepaid. Okay, very good. Now we are going to discuss the account.
But can you tell me how is it liability? Like there's no ownership on
Because
that
we
now?
need to pay this. We haven't paid yet. The whole
Okay.
year has been passed, but we haven't paid yet. Then that is the liability for the company. This is the obligation which we need to pay.
Okay.
Okay. Okay. First of all, now remember one thing that for the expense account, you should remember one mnemonic, and then mnemonic is P A A P P A A P PAP account. Now, what does it mean? Sometime you will see some of the prepaid expenses at the start of the year. It means that maybe you have paid some extra payment for the expense. And sometime you will see some accrued expense at the start of the year. Means that uh, you incurred the expense, you have used the service, but you haven't paid yet. So this P is basically prepaid expense. This A is accrued expense. This A is accrued expense, and this P is the prepaid expense. So if you have the prepaid expense at the start of the year, debit side at the start of the year means that your opening balance, if your balance BD is prepaid, so you will be writing it here on the debit side. And if your opening balance is accrued, so you will be writing it here. And if your closing balance means the balance at the end of the year or month, if it is accrued, so you will be writing the closing balance here. And if the closing balance is prepaid, so you will be writing it here. But this will shift here after that. As you can see, this closing balance will be opening balance for the next year, and this closing balance will be opening balance for the next year. As you can see, then again the same thing is going to start. So basically, this is the period. Automatically, it will shift here just like that. So it means this balance is also the prepaid balance of the last year, and this balance is also the accrued balance of the last year. Okay, why we are writing this on the debit side and on the credit side? If your balance is prepaid, expense is prepaid at the starting of the year, so it means that this is the asset for the company. And that is why we know that whenever we need to record the asset, so we will write it on the debit side, even though this is the expense account. But we will be using the same method or the same logic that why we are recording this on the debit side, because it's the kind of asset for the company. And why we are recording this accrued here on the credit side, because this is a liability for the company. Okay. And there are some other entries as well. Uh, okay, so this is about the accrued and prepaid expenses. But whenever you need to decrease the bank and increase the expense, so you will be writing your bank entry here, bank or cash, meaning that expense debit and bank or cash credit. And when you will transfer your annual payment in the income statement, so as I told you that whenever you need to transfer the balance of the expense account in the income statement, so you will credit the expense account just to finish that, and all the expenses and losses will be debited in the income statement. This is how we need to prepare the expense account. Understood?
Yes,
Oh, if you want to write it, so you can stop it at the start the income account.
I already
After
wrote
being done
everything.
with the done.
Yes.
Okay. Now we are going to discuss the income account. Let's say that this is my commission, no, rent received account. Okay. So let's talk about, first of all, income. Accrued income, and we can also say the, okay, accrued income. Let's talk about. Okay. For example, there is your tenant. A tenant needs to pay 20,000 dollars to you in order to use your factory. for 1 year. Yes. A tenant needs to pay $20,000 to you in order to use your factory for 1 year. This is the annual payment. But it's been 1 year, but tenant provide only $10,000. First of all, if the annual rent is 20,000, so let's find out the monthly uh, rent. 20,000 divided by 12. Monthly rent is 1666. This is monthly rent. So if they pay $10,000, if they paid 1 second. Okay. So if they paid $10,000, so approximately, let's say that the tenant paid 6 months payment, for example, or maybe less than this, but let's assume 6 months payment. And he has used your factory for the whole year, but he had paid you only 10,000 for the 6 months. 10,000 left. The $10,000 is left. So the $10,000 which is left, $10,000 which is left, this $10,000 will be accrued income. It means that the year has been passed, you have given the service as well, but you haven't received the amount. Maybe full amount, maybe half of it, 2% of it, 5% of it, whatever. So what does it mean, accrued income? So in conclusion, accrued income is the income which a company didn't receive from customer, but has income. Okay, so it's been 1 year, but they didn't pay. So this is the accrued income. And since we have given the service, but he didn't pay. We have given the service, but he didn't pay. So this accrued income will be asset for the company because we can show the ownership. We have given the service against that income, but we didn't receive it. So this is the asset for the company, accrued income. Understood?
Yes.
Next, we are going to discuss the prepaid income. Prepaid income simply means the income, or you can say the unearned income. Unearned income means whole year has been passed, even any service for next year, but we receive the money. Receive the income, or you can say advance. So you have received the income from your customer, but on advance basis, but you haven't given the service yet. Okay. Now this advance income will be the liability for the company because you haven't given any service, but your customer can show the ownership on that. The customer could say in the future that I don't want to continue with you. That is why I want a refund of my advance money. That is why you receive the income from them for the next 4 to 6 months, but you haven't given any service yet. So it means that you have to pay it back to the customer sometime. That is why this is a liability for the company.
Accrual income is asset.
Accrued income is asset, prepaid income is liability.
Okay. Also, I was reading one past paper and it was written that rent was amounted to. What does amounted to mean?
Rent was what?
Amounted to. They used the word amounted.
If I say the rent amount is 15,000, so I can say rent amounted to 15,000. So it simply means that this is the rent. This is the rent amount.
Okay, never mind.
Okay, so this is okay. For the income account, you will use one mnemonic, and that is P P A, APA account. So it A means accrued, P means prepaid. It means that if at the start of the year, at the start of the year, if you have the accrued income, so your balance, opening balance of accrued income will be coming here. And if at the start of year your opening balance is prepaid, so you will be writing it here. And if your closing balance, if they will give you the closing balance as well, and that is prepaid, so you will be writing it here. And if your closing balance is accrued, so you will be writing it here. And this will automatically be debited to your account. Now, why we are writing this on the, since this is the accrued income and this is the asset for the company, because we have given service but didn't receive the money, that is why this is on the debit side. And it's prepaid income, since we haven't given any service, but we receive the income in advance. That is the liability for the company. That is why we are adding it here on the credit side, the prepaid. And whenever you will receive the income, so the income will credit, and we know that it will be on the credit side, and your bank or cash increased. Then received credit, bank or cash increase, it is debit. And when you need to transfer your annual rent received income into the income statement, so rent received account is going to zero, like we are going to close it down. That is why we will be recording the entry uh, according to its opposite nature. Its opposite nature is debit. It means that we will debit the rent received account. So, and we will need to credit the income statement account. Income statement. So rent received debit, income statement credit. Because we know that all the incomes will credit in the income statement. This is how we need to prepare the expense and income account. Understood?
Yes.
Okay. So let's discuss one of the question. Okay, so you done with the writing as well?
I am.
Okay. You're writing
Yes, I'm writing like while
like
you were talking, so I'm done writing.
this one?
No, no, I'm done writing all of this.
Okay, done. Okay. Yes, this is yes, approval and prepayment topic 7. Yes, you can see that we have to prepare a stationary account here. Stationary account is the expense account, and we need to prepare the rent received account. Yes, as you can see, the balances given below were taken from the books of K. Leon on 1st July 2003. So this is stationary is a debit balance. It means that we need to write it on the debit side. This is prepaid expense because we use PAP account for the expense. And then we will see this transaction. Following transaction took place during July 2003. About stationery $160 on credit from the post suppliers. So we will be recording this on the debit side. Received a check from the M Millen. So this is not related to stationery account. Received, and this is again not related to stationery account. About stationery 220 by check. Yes, this we will be writing it. And sold goods to M Millen. This is again not related to stationery account. Sent a carrot note. Okay, so this is again not related to stationery account. This is again not related to stationery account. Received a cash refund of $40 for unsatisfactory stationery return. Okay, so this is a refund. Because expense has credit and since cash back into the business, we record a refund, so cash will be debit. Yes. So you will be like balancing your answer. That's it. This is how you need to prepare this. But let me tell you that which account you need to. Okay. So you can do this one. Bad debts account is also the part of it. You can write it on your notebook, like the page number 177, 178, and 179, 182, and 183. Yes, these are few questions which you
Okay.
need to understood. If you have any like if
Yes.
you would find any difficulty, so you can text me. I'll answer you.
Okay.
Okay, Hamda. Allah Hafiz.
Allah Hafiz.